Smart money just added massive exposure again this week. And listen, my primary gold bias right now, it's heavily bullish. But here's the thing, the real opportunity is only going to appear after a highly specific liquidity sweep. So let's look at exactly what institutions are positioning for right now in this explainer.
Look at this statement on the screen. Price moves toward liquidity, not toward opinions. Let that really sink in for a second. Retail traders, they're reacting to red and green candles, trend lines, market emotions, but institutions, they literally do not care about your opinion. They operate entirely on algorithmic pricing models that are strictly designed to hunt down areas of high liquidity. So to catch gold's next move, we've got to stop looking at the chart like retail and start seeing the actual institutional footprint.
So before we even look at the evidence, let me just give you the outcome. Based on the current positioning and liquidity conditions we're seeing, my weekly bias is a bullish relief rally. The algorithmic primary target for this week, it's the buy-side liquidity resting right between $4,235 and $4,250. That is exactly what smart money is trying to accomplish. They're gunning for the liquidity resting right above those recent highs. Everything we're going to look at from here on out is simply the institutional footprint proving this exact thesis. All right, let's dive into the actual evidence. Now, to the untrained eye, the disaggregated commitments of traders report looks heavily bearish. But look a little closer. This data reveals exactly what the absolute largest market participants are doing with their capital behind the scenes. While the retail herd is out there aggressively shorting the breakdown, this data proves that institutions are actually secretly building a floor. The real magic happens when we translate this raw data into institutional intent. Just look at managed money. These are your heavyweight hedge funds. Notice what they did? They executed an aggressive, double-pronged maneuver. They added over 5,000 long contracts while simultaneously and violently covering more than 9,000 shorts. Guys, that's not just a minor portfolio adjustment. That is active, speculative accumulation happening at deep structural discounts. They are essentially squeezing shorts out of the market while retail remains completely oblivious, probably busy drawing another random trend line on a 1-minute chart.
And this brings us to what most traders are completely missing right now. We are seeing a massive divergence between the macro trend and smart money flow. Look, yes, the higher time frame trend is absolutely bearish. And yes, prices entered a deep structural discount array, sweeping major sell-side liquidity at 4,030. And because the chart looks so bearish, what does retail do? They continue chasing breakout shorts directly into the absolute lows. But as we just saw in that COT data, smart money is quietly engineering a reversal floor. They've already captured that sell-side liquidity, and now their immediate objective is to sponsor a short-term repricing higher.
So this structural setup reveals our primary target. You have to realize the daily time frame isn't just basic technical analysis. Think of it as a literal map of resting liquidity. See that unmitigated fair value gap? It's sitting there like a massive algorithmic magnet, right at the 4,250 level. Whenever price extends into a deep institutional discount like this, and smart money has accumulated longs, the algorithm simply must rebalance those internal price inefficiencies. That zone, that's the bullseye.
Now, dropping down to the 1-hour execution map really builds out our immediate operational framework. Notice the internal structure here. We have engineered equal highs resting perfectly at 42.35. Now, to a retail trader, that just looks like an impenetrable ceiling of resistance, right? But to an institutional algorithm, that is a pristine, untouched cluster of buy stops. That 42.35 level is absolutely going to act as our first major draw on liquidity before we even reach that daily imbalance up above.
So the absolutely crucial concept here is understanding the draw on liquidity, or DOL. You see, the market isn't random. It doesn't just wander around. It is algorithmically drawn magnetically toward unmitigated premium inefficiencies and resting stop losses. This is the difference. Most traders are hyper-focused on price. Smart money is entirely focused on liquidity. Right now, the programming is heavily magnetized toward those 4,235 and 4,250 premium arrays, simply because that's exactly where the counterparty liquidity is resting for institutions to eventually offload all those longs they are currently accumulating.
And here is exactly where institutions might be setting a trap. In fact, it's the exact trap most traders are going to walk right into. The retail perspective is super simple, right? Sell the breakdown, assume the trend lasts forever, and just park those stop losses safely above the 4,235 resistance. But the smart money perspective is the complete inverse of that. They are actively buying the deep discount, and they are explicitly targeting that exact 4,235 stop loss cluster.
Retail traders are literally handing over the liquidity fuel that institutions are going to use to launch this incoming counter-trend rally.
Now, algorithms do need a macro excuse to actually start moving. They need a catalyst. Just look at Tuesday's economic calendar. We've got US core retail sales coming up. This is the exact fundamental event institutions are likely going to use to engineer volatility and trigger these planned liquidity sweeps. Honestly, the actual data outcome itself is totally secondary. The event just provides the necessary volume injection they need to aggressively reprice the assets straight toward our defined targets.
Which perfectly brings us to the expected weekly rhythm, the accumulation, manipulation, and distribution cycle. So Monday, it's likely going to be pretty quiet, just accumulation and consolidation floating around the 4,180 mark. They're basically engineering short-term liquidity pools on both sides. Then comes Tuesday, the manipulation phase. This is where we expect a Judas swing, a violent, completely engineered fake-out drop right into the 4,150 discount level. This is specifically designed to trap late sellers the exact second that news hits. Once that sell-side liquidity is finally swept, we shift right into distribution, meaning a violent expansion through Wednesday and Thursday, heading directly up into our 4,250 premium targets.
All right, so here is the precise execution playbook, tying all of this institutional evidence together. Our direction is strictly to buy, period. But only following that Tuesday Judas swing. We are looking for an entry zone deep in the discount structural array, right between 4150 and 4160. Our trigger is going to be a 15-minute market structure shift showing clear displacement. Once we're in, we secure partial profits at 4,235 as they sweep those engineered equal highs. Target 2 is our 4,250 daily fair value gap. And if you've got a final runner, let it stretch to the premium structural resistance up at 4,285.
But listen, true institutional trading requires absolutely rigid risk management. So what proves this entire thesis wrong? A clean daily candle close below 4,120. If that happens, the structural integrity of this bullish retracement model is completely destroyed, and it means the algorithm has reverted right back to macro markdown. But until that happens, the data, the positioning, and the structural map are all pointing higher. The liquidity is sitting right up there waiting. So only question left is, are you going to be the one hunting it or the one providing it?